Hello everyone, let's talk about sales taxes. So sales taxes are an extra amount of money that is charged as a fixed percentage on the sales price of all items sold, but some items are not taxable. Essentially, the state or the county sets a certain percentage where that percent of every dollar of merchandise sold is assessed as tax. So if you live in a county that has a 7% sales tax and you buy an item worth $100, well, you got to pay $7 in sales tax. When items are sold, the merchandiser collects the sales tax at the time of sale from the customer and holds on to it in an account until it is paid to the government. How often they have to pay depends on the size of the business. Some smaller businesses only pay annually, some medium-sized businesses pay quarterly. Very large businesses will have to pay monthly. So how often you have to pay in depends on the size of your company. But for your company, while you are holding on to that money, you need to carry it on your books as a liability. It is your sales tax collected that you are liable to pay to the government. Let's do a journal entry for a sale, but this time we're going to take sales taxes into consideration. The sales tax in Marcadia County is 9%. On December 24th, a retailer sold $2,000 worth of merchandise to a last-minute shopper. Well, what accounts are going to be affected in this journal entry? There's going to be cash. We're collecting money from the shopper. There's going to be sales revenue. We're selling items to this last-minute Christmas shopper. And we're also collecting sales tax from this shopper, which we're going to hold in that account that we are liable to pay to the government later on. So we're going to call it sales tax payable. It's our liability. We have an asset account, a revenue account, and a liability account. We're receiving the cash, so that asset is going up. We made more sales during the period, so our revenue account is going to go up, and we owe more money to our local government in that sales tax payable liability account, so that's going to go up. And assets always go up with a debit, while revenues and liabilities both go up with a credit. So the journal entry for the sale of $2,000 worth of merchandise to a last-minute Christmas shopper is going to be as such. On December 24th, we are collecting cash. We're going to record sales revenue equal to the retail or face price of the goods that we're selling, which is at $2,000. But we're also collecting sales taxes. How much are we collecting in sales taxes? Well, we simply multiply the amount of merchandise we sold by the applicable sales tax rate. So 2,000 times 0.09, 9% of 2,000 is $180 in sales tax that we're charging to this customer at the time that we are making the sale, which means the total amount of cash that's going to get handed over from the customer is $2,180. So your debit to cash is equal to the sum of your two credits in this case. For these particular entries, sometimes you want to work from the bottom up. And this is our journal entry to record the cash sale of merchandise. Another journal entry that's almost exactly the same. On December 25th, a retailer is going to sell $3,000 worth of merchandise to a real last-minute Christmas shopper. Well, this is just like the entry we had before, which means everything within the 5 steps to record a journal entry is going to be exactly the same. Cash, sales revenue, and sales tax payable are being affected. They're still the same type of accounts. They are all going up, which means that cash is going to be our debit, and we're going to have a credit to both sales revenue and sales taxes payable. When we start with our debit to cash, we'll figure out how much that is in total in a minute. We'll record sales revenue equal to the face value of the merchandise, which was $3,000. And we're going to create a liability for the sales taxes that we are collecting from this customer, which we're liable to pay to the government, based upon the applicable sales tax rate, which again in this county is 9%. So we're charging 9% of $3,000. That is $270 in sales tax this customer has to pay that we are going to collect and hold on to until we send it out at the end of the month. And in total, the customer is going to hand over $3,270 in cash, and we recorded the sale of this merchandise. So let's just assume here that those are the only 2 sales this retailer made, and they collected the sales tax during the period. Well, they eventually have to fork it over to the government. So what happens when the retailer makes, in this case, its monthly payment to the state for the sales taxes collected? Well, one account that's being affected is going to be our sales tax payable. We're paying off that amount that we withheld, which means we can't have that liability on our books anymore, so we need to get rid of that. And the other account that's being affected is what we're handing over to the government, which is the cash from the sales taxes that we collected. Sales tax payable is a liability, cash is an asset. Our sales tax payable, when we pay off this debt, is going to be going down, and since the cash is coming out of our account, also going to go down. Debit sales tax payable, credit to cash. for the total amount that we collected, which was $450. How did I get there? Well, we had two transactions. We collected $180 on December 24th. On December 25th, we collected another $270. That's $450 total credit balance to our sales taxes payable account. And whenever we pay it off, we just make it equal to zero. So the amount that we pay in should always be equal to the amount of taxes that we have collected up until that point. One quick note that I'm not going to require you, but I have seen people, instead of just having a cash account when they pay out sales tax payable, will use a subsidiary of a cash account, which is called cash restricted for sales taxes. You may see that somewhere. Don't want to catch you off guard like it's something different. They're just separating their cash between what is their cash and what is the cash they're holding on to that they have to pay in later on.